Vineet, are we good to start?
Yeah.
Good morning,
Yes, sir.
ladies and gentlemen, and thank you for attending this virtual meeting. I'm pleased to welcome you on behalf of EIH Limited and SKP Securities to EIH Limited's F1 FY26 earnings webinar. We have with us Mr. Vikram Oberoi, MD and CEO, and Mr. Vineet Kapoor, CFO. Friends, this virtual meeting is being recorded for compliance reasons, and during the discussion, there may be certain forward-looking statements. These must be viewed in conjunction with the risks that the company faces. We'll have the opening remarks from Mr. Oberoi, followed by a presentation and then a Q&A session. Thank you, and over to you, Vikram.
Thank you so much. Good morning, ladies and gentlemen, and a warm welcome. We just had our Q1 results, and unfortunately, the hospitality industry, and we're no exception to that, were impacted by Operation Sindoor, the tension between India and Pakistan, and also the geopolitical developments, in particular between the US, Iran, and Israel. But despite those ruffles, we had a strong EBITDA performance for Q1. It would have been better had it not been for that. What we see overall in Q1 is still strong demand over the previous quarter of last year, and we again remain optimistic. One of the things that I've been mentioning for some time is our endeavor to drive ARR, and that obviously is easier when you have strong demand. Typically in the summer months, our industry does face a softening in demand, but despite that, you'll see from the investor presentation that has been loaded on for you to review, we've been able to take average room rates up, and as a result, RevPAR up as well, but a strong increase in average room rates. And our endeavor would be to continue to drive rates. One of the key advantages of driving ARR is that the flow through to EBITDA is much stronger than if it was just an increase in occupancy. So that is our endeavor. We have world-class hotels in our country, us and our competitors. They are the finest hotels probably in the world. And certainly our approach is to drive ARR to reflect the quality of the hotels and the quality of service we offer. So with that, I'll pass it over to Vineet for a quick run through our presentation, and then we can open it up to questions and answers. Thank you very much.
Thank you, Vikram, and good morning, everybody. We'll start with the Indian hotel sector first. For the outlook perspective, we see a pretty good, strong hotel demand coming through for the current year, 2025. And the factors already mentioned there on the growth drivers. A lot of factors driving that growth, but majorly coming from a good increase coming from a demographic shift of the Indian population and a good increase in US&I base, as well as a good forecast for inbound tourism to grow by 15% in the current year. If you look at the Indian hotel market, especially for Q1 26, we got impacted, as mentioned by Vikram, in the first quarter because of Operation Sindoor, the geopolitical situations in the Middle East. But in spite of that, we saw an increase happening in passenger traffic by 4.4% on a year-over-year basis. And that reflected also with a good buoyancy in the ARR. We almost saw an increase of 9 to 11%, though on the occupancy, we were more or less flat. But overall, with a good ARR increase, we saw an increase of 11 to 13% on RevPAR versus last year. So we expect from a management perspective, we expect the demand for high-end luxury to grow and become more prominent on the luxury side. And with our portfolio of luxury hotels, we feel ourselves we are in a good position to get the most benefit of India's evolving opportunities. Considering that, we're already working, we are very focused on our local domestic market as well as in the international destinations. We have a strong expansion strategy with almost 25 new properties, mainly focused in India, but also it's in some global markets, but to be operation by 2030. Coming to operational performance, EIH is consistently has maintained leadership versus the competition, and we continue to lead in most of the areas, including occupancy. We have maintained an overall 20% lead over the competition if you see over the years, though of course that has been cyclical based on the market demands and the cycles. But more or less on average, we have maintained 20% leadership over the competition. On the RGI front, looking at MPI, we are higher by roughly 6. And if I compare that 3 years back in June 22, increase on the occupancy side. On the ARI, on the ARR, there has been some drop, but overall a very strong leadership on the RevPAR side. Continuing on the RevPAR movement, it's the same cyclical trends what we see every year, and the same cycle goes. I think important to note would be the base. If you look at we are from 9,811, we ended up at 11,350, which is a growth of 16% year over year on average versus last year on RevPAR. And we continue to see this base increasing year over year. We also foresee a good strong base going for the next years.
Vineet, may I just add one thing? This the RevPAR growth in Q1 of this year versus Q1 of last year. We see, as you know, foreign travel to India declines come April or middle of April onwards. And despite that, we have been able to take up our rates, and our endeavor will be during the winter months to drive that even further, supported by foreign travel into India.
Coming on the next slide, which is the RevPAR growth by industry and by the hotels. So industry growth was roughly at 12% in Q1. Our owned and managed hotels grew a little higher than the industry growth of 16%. Oberoi Hotels continues to lead the pack with a growth of 21% on a RevPAR basis over last year. If you look at the same on the occupancy and the ARR trends, so we started the year pretty strong in April at 77%, but we saw a dip happening in May, especially impacted by Operation Sindoor as well as the geopolitical situation in the Middle East. That has picked up a little in June, and we hope to see that trend changing in the current quarter. But overall, in spite of changes in the occupancy, we saw a pretty healthy growth on ARR side in every month. So on a net basis, if I look at overall quarter, we were almost flat at 70%, but a good increase, almost 18% growth in ARR versus last year. If I look at the same thing for EIH owned hotels, actually we saw a dip in occupancy, and the dip was more prominent in the month of May, especially impacting our hotels in the northern region of India. So overall, the occupancy dipped from 77 to 73%. We got an impact even in our city hotels in the month of May. But overall, good. In spite of the occupancy drop, we were able to maintain the ARR and able to grow that versus last year. If you look at growth by city in our hotels, including managed hotels, we saw a pretty good healthy trends, except what you see in Shimla and Chandigarh, which were basically impacted the Operation Sindoor, where the travel to the northern part of India was definitely restricted. But at the same time, we saw a good increase in RevPAR in Jaipur and Ranthambore areas, Hyderabad in particular, we saw a very high increase, but that was because of a one-time event. We had the Miss World event, which took place in Trident, Hyderabad, and hotel was occupied quite number of days, which drove the ARR for us in Hyderabad. On the international front, also we saw a good healthy increase, and this due to good performance by our hotels in Mauritius, Egypt, as well as in Marrakesh. Egypt and Marrakesh basically coming back versus last year due to the impact of Israel and Palestine conflict, which had impacted the room nights for those hotels last year. That's coming back in the current year. On the room revenue tailwinds, I would say more or less in the same lines. Nothing dramatic from any particular segment perspective, but we saw a impact on corporate segment where we are seeing a little drop in base in Q1 versus our last 2 to 3 years average. But otherwise, most of the other ones are in the same trend as last year. Coming to the Q1 financials, the standalone, I'll start with the standalone, starting with standalone performance. So looking at the Q1 F26, if you see over the last 6 to 7 years, leaving aside the COVID period, even last 4 years, we had the highest revenue in Q1, highest ever revenue in Q1, as well as same thing on EBITDA. PAT was not in the same line, and that was because of one-time impact. We had taken 110 crores impact in our financials on account of Mashobra, which came in Q1, and due to that, the PAT was on the lower side at 36 crores for the quarter. Looking into the same, if you look at the consolidated performance, again, on the revenue and EBITDA side, we had the highest ever revenue and EBITDA for the quarter. PAT was lower because of the Mashobra impact of 110 crores, which lowered our PAT for the quarter. On the funds position, the funds continue to we keep on adding our positive cash flows and keep adding to the funds, which basically gives us a good situation to be in with a very healthy liquidity at this moment to push our growth plans, our long-term growth plans to support in the coming years. Coming on the financials in detail, if we look at on the consolidated level, our overall revenue went up by 9%. Expenditure was actually in good control. We only had a growth of 6% on expenditure side, which resulted in a higher drop-through of almost 16% on EBITDA. Looking at the percentage on the EBITDA, we ended up the quarter with 32% EBITDA percentage versus 30%. So good improvement in EBITDA percentage overall. On the operational side, good performance, but at the same time, we got impacted by Mashobra due to the court judgment which came in the month of June. That resulted in an impact on our PAT. We were down on 62% because of the 110 crores impact on account of Mashobra. If you look at the standalone performance, again, a good growth of 15% over a year, and this is in spite of the fact that we didn't have Grand and Oberoi Airport services in the last quarter versus last year we had both the things in the numbers. On the expenditure side, same trend, has grown lower than the growth what we have seen in terms of revenue, which has helped us to increase the EBITDA drop through and a good growth of 28% versus last year. On a EBITDA percentage, we have gone from 30% to 34% as of Q1 FY26. On PAT, we were down versus last year due to, again, the exceptional item of Mashobra of 110 crores. On the awards and accolades, Oberoi, there's the list of awards which Oberoi Hotels has won. We continue to lead in the luxury segment and also get reward, also getting good rewards across across different uh, from different authorities. If you look at Telegraph Travel Awards, we got the Best Hotel Group Award from Telegraph Travel Awards. We were ranked number 2 among the best hotel brands in the world by Travel and Leisure USA. Uh, the list goes on, and if I look at the next sheet, we also our restaurants also were awarded to be the best in terms of their own categories. Going to our next expansion plans, we continue to drive a very healthy pipeline on the hotels. We just recently signed 4 hotels which are going to be managed. So with this overall, our list is roughly 25 properties with 2,033 keys, spread out across domestic and international, but mainly in domestic. If I look at number of keys in domestic front, out of the 2,033, we are coming with 1,750 keys in domestic, and the remaining keys in international. Out of the 25 properties, we'll be owning 8 and managing 7. So overall, a good growth pipeline coming in at this moment till 2030. This is the business footprint across national and international, along for Roy as well as Trident. Total number of keys in India is roughly 3,700. At the same time, 408 keys for Roy International in the international locations. I'm through with my set of slides. Over to you, back to Naveen.
Thanks, Vinny. Thanks, Vikram.
Thanks, Naveen.
Friends, we open the floor for the Q&A session now. Anyone wishing to ask a question, request you to please raise your hand. We'll take the first question from Abhishek. Abhishek, please unmute yourself and go ahead.
Yeah. Hi, good morning. I have 2 set of questions. One is regarding the RevPAR. So basically, what I've observed that the average RevPAR which is given across the industry and for EIH should be including the F&B revenue as well, right? Otherwise, the math doesn't add up.
First of all, good morning, Abhishek. The RevPAR is revenue per available room. It does not include F&B and other income.
Okay. So if we have to just, do a math on the revenue for Q1 FY26, and if we try to take the RevPAR and multiply it with the number of available rooms into the occupancy ratio, say maybe an average, if it is 70% or 75%, it adds up to the entire revenue. That's my question. It shouldn't add up
No,
to the
so
entire revenue, right?
yeah. So I'm not sure what data you're seeing for others, but hospitality RevPAR very specifically across our industry refers to revenue per available room based on room revenue. It does not include food and beverage revenue, and it doesn't include revenue from minor operating departments. And that's an industry-wide practice, but I'm not sure what data you're referring to for others. And if you want, we can certainly take this offline and better understand what data you're looking at to answer any further questions you have, if that's okay. But ours very clearly is revenue per available room for room revenue only. That I can assure you.
Okay. And another question is on the case for which we have taken an exceptional hit of 110 crores. What I understood earlier is that we were to receive a substantial sum through because we are surrendering the property back to them. But now in this particular quarter, we have taken a hit of 110 crores. So how do you see this going forward?
I don't want to make any statements on how I see this going forward. The 110 crore is based on the judgment of the court and us accounting for that based on that. And if there may be questions, so Vineet, can I just maybe hand it over to you to just give a summary of that 110 crore exceptional item for Wildflower or for Mashobra?
So, I mean, the 110 crores actually constitutes of various, and then ultimately we have passed the accounting based on the court judgment. The 110 crores is on account of net impact of the equity value which we are not receiving based on the court judgment, and also impact of 50% of advance against equity which were given to Mashobra, which has not been considered by the court. So that constitutes the 110 crores.
So
Plus,
I have also seen that we have written back the used fee that amounts to 86 crores. So that we expect that we are not going to pay and we are not going to receive any sum beyond this, right? That's the thing to.
So,
The recovery
that
user
was
fee, yeah.
86 crores was the user fee what we are mentioning. That was the amount we were carrying in our provision in the books, considering that, and that was in lieu of having the property. Considering that stand was not taken by the court, we have reversed that user fee, which was sort of a lease rental which was payable to the state government. So net of that, all those three impacts is 110 crores.
Okay. So, this is another thing. Now that the property is given back to the government, I mean, that's very evident that there is going to be a hotel resort there, which is going to be managed by the hospitality players in India. So, do you expect that going to our competitors, or you would expect that there's a chance of us getting it back?
So we're managing the hotel currently, as you know, on behalf of the state government, and we will endeavor to, once the bidding process is announced and the criteria for bidders is disclosed, our endeavor will be to continue to operate the hotel on terms that are favorable and are a win-win for both the Mashobra government or the Himachal government and us. So that's our hope and our endeavor.
Okay. Thanks.
Thank you, Abhishek.
Thanks, Abhishek.
We'll take the next question from Amit Agarwal. Amit, please unmute yourself and go ahead. Amit, please go ahead. No, there's a disturbance in your line, Amit.
Yeah, Amit, your voice is coming out muffled. We can't, unfortunately, hear you clearly.
Amit, may I request you to disconnect and join again, and we take your question? Thank you. Meanwhile, we'll take the next question from Raghav Malik. Raghav, please unmute yourself and go ahead. Raghav, you need to unmute.
Hi, am I audible? Hi, am I
Yes, you
audible?
are. Please go ahead.
Yeah, hi, good morning. Thanks for the opportunity. Congrats on a good set of numbers. So the first question was just a follow-up on the RevPAR question. So in your PPT, you've detailed that domestic RevPAR is higher about 16% and international is 22% higher, but consolidated revenue is about 9% higher. So what is the gap between this RevPAR and revenue growth number essentially?
So, Raghav, the numbers what you're seeing on that's mainly on hotel. So the three things which impacted us on consolidated basis was one was Mashobra versus last year. Considering that we already handed over the property on 31st March, we are no longer consolidating Mashobra in our numbers. So that is not there in our revenue year over year. At the same time, we also been impacted by Grand, which is actually closed for renovation. We had full Grand operations last year, which we don't have now. And on top of that, we also had our Oberoi Airport services in Mumbai, which was there last year, but not in the current year. So due to that, one-to-one tie-up with RevPAR will not be possible with the revenue.
Okay, okay, understood. And for international hotels specifically, the RevPAR, the slight details that it is including the hotels that were impacted by the recent Middle East conflict. So what is the like-for-like number then? 22% on a non-like-for-like basis is 22%. What is like the number that would be, X the hotels that might have been impacted because of the conflict?
Raghav, actually, is the other way around. What had happened last year was Marrakesh and Egypt, and to an extent Mauritius. These three entities were impacted by the Israel-Palestine conflict, which was pretty much more, impactful for these countries. Considering that that has evened out, and the impact was more for Iran, we are not seeing the impact what we had versus last year. That has actually improved.
Yeah.
for the
And
current
if
year.
I could just add to that, Raghav, in Egypt, we've also made some changes in how we are operating, which has resulted in a sharp growth in Egypt. So one is external factors, but I think due to internal changes that we've made in positioning the hotel, that has also helped see a strong growth in revenue and therefore RevPAR as well, both in occupancy and not in rates so much, but in occupancy. We've seen a sharp increase in occupancy as a result of that. And in Mauritius also, we've seen an increase as in Marrakesh. So I think all of that has contributed to the increase you see in RevPAR for international.
Okay, understood. Thank you, sir. And if I may just squeeze one last follow-up. So I know you don't give guidance on the existing months, probably, or the existing new quarter, 2Q, but in terms of just the trend, like occupancies, like halfway sort of caught up, I think in June, after the dip it's seen in May. So is there like a upward traction that we're seeing again in July and even August maybe, or is it like somewhat sustaining now at June levels, just occupancy for the portfolio?
Yeah. Well, do you know, in Q3 and Q4 in particular, we see the whole industry move up. And I don't want to make any forward statements, but the only thing that I'd like to highlight is some facts. First of all, Q1, despite all the issues that we faced as an industry in India, we were able to drive a RevPAR. And our endeavor will be to do that in Q2, Q3, and Q4. And I think in Q3 and Q4, our endeavor will be to really maximize opportunity, given we anticipate strong increases in demand, which are customary every year.
Okay, understood, sir. Thank you. I'll come back in the queue.
Thank you. Great, Raghav. Thank
Thank
you.
you, Raghav.
Please call me Vikram, Raghav. I'd feel much more
Sure, sir.
comfortable.
Thank you.
Yes.
Thank you, Vikram. Thank you.
Okay, thanks so much. Thank you.
Here's the question from Amit Agarwal. Hopefully his line is right for now. Amit, please unmute yourself and go ahead. Amit? Yeah, you need to unmute yourself and ask your question. Please go ahead. Yes, he's still facing some issues. We'll take the question from Vaibhav Dinesh. Vaibhav, please go ahead. Please unmute yourself and go ahead.
Am I audible now?
Yes, Vaibhav, please go ahead.
Okay, perfect. Hi, Vikram. Hi, Vinit. First of all, congratulations on a strong set of numbers despite all the challenges. Firstly, on your performance in owned hotels versus your own domestic owned and managed hotels. So occupancy impact in owned hotels seems higher, while ARR growth is much better in the owned hotels compared to domestic including managed hotels. So is there a strategic shift that we are targeting in our own hotels where focuses on commanding higher ARRs even at the expense of occupancy going forward? Is it a strategic shift?
Good afternoon, Vaibhav. No, actually, our endeavor is to maximize rates across our hotels. That, of course, is subject to demand. just applying the simple principles of supply and demand. A lot of our city hotels are EIH-owned hotels, and although, for example, Delhi had a significant impact, Bangalore had a significant impact because of the political tensions, we were still running strong occupancies in the month of April, and by reducing rate, we didn't feel we would stimulate additional demand, because I think it was a crisis beyond our control, and people will choose to travel and not travel. Safety and concerns would come first. So we saw a decline in demand, and we also, really in pace of reservations and cancellations, particularly as a result of Sindoor. But our city hotels have run high occupancies both in summer and in winter. And the differential isn't that much because business travel still happens. Whereas our leisure hotels, we really see sharp declines in foreign travel to our leisure hotels in the summer months. And therefore, your ability to drive rate in leisure hotels when demand tapers off is lower. And that's really it. But our endeavor is to drive rate when demand is strong across every single hotel. And in fact, our leisure hotels they offer a level of product and service which is unmatched at global standards. So and therefore operate at much higher rates. Our leisure hotels operate well over 50% ARRs. In fact, 60 and touching 60 and beyond in the winter months, averaging in the 50s if you look at year round. So they command much higher rates than our city hotels, particularly in the winter months.
Got it, sir. My second question was on your pipeline. So I can see there are some delays that have happened quarter on quarter. Mainly, I can see the Oberoi Dahabia 1 and 2, which were supposed to be operational in 2025, are now postponed to 2026. Similar is the case for Nepal property and few others. So what was the reason behind the same?
So these hotels are all managed hotels, and although we work very closely with our partners, if there is a delay, our influence over those on the timelines, because these are managed hotels, is not as much as hotels that we own or have a significant equity interest in. So it's nothing more than that. Our endeavors to work with our partners, be sensitive to their needs, support them the best we can, and open the hotel as soon as possible.
So I can presume that there is no impact on our own properties expansion plans.
No, that is correct.
Perfect. Just if I may ask last one question on the impact of closure of Oberoi Grand and Wildflower Hall. So what kind of impact was there because on the closure of these two properties? Along with that, what was the impact of closing of the airport lounge business?
Yeah.
And also, if you can share the revenue numbers for the OFS and OFS.
So I don't know if we share numbers. Vineet, you just want to take that question? I don't think we disclose numbers for
OFS
and OAS.
Yeah, so overall, I'll not share anything specific on the profitability, but on a revenue side, I can just give you an indication. On the Grand, if I look at between Q1 of this year and last year, we had roughly an impact of 22 crores, which we had on account of Grand. On Oberoi Airport Services, the impact was roughly 28 crores.
28 crores.
Yeah, and that was more than offset by
OFS.
By OFS subsequently. So that I can assure you.
Got it. And about Wildflower Hall?
Yeah,
Wildflower would have been approximately the same because last year we were consolidating. On revenue front, there was no impact.
Oh, got it. Perfect, sir. That's it from my side, and all the best. Thank you.
Thank you so much.
The next question from Vaishnavi. Vaishnavi, please unmute yourself and go ahead.
Good morning, sir. Thank you for taking my question. I just have one question from my end. This is regarding the exceptional items. Do we see any other future exceptional items to be recorded from the Himachal property, or the current one is the final one?
Do you want?
I would say the current one
This
is the final one. We should not see any more exceptional items coming from Himachal, from Wildpark.
Thank you, sir.
Thank you, Vaishnavi.
Thank you, Vaishnavi. We'll take the next question from Amit Agarwal. Amit, please go ahead. Please unmute yourself and go ahead. Amit, you need to unmute yourself. Yes, please go ahead, Amit. Still facing a problem with his connectivity.
Perhaps Amit could maybe type his question in.
Amit, can you please post your question on the Q&A board and I'll read it out. The next question is from Amit Kadam. Amit, please go ahead.
Yeah, hi. Hi, Vikram.
Hi, Amit.
Hi, Vinit. So my question is just I want to go back to the back when we had shared this Vision 2030, where we had shared that we want to double our room counts, and then we had seen a series of some activities and actions regarding. Whereas now, if I look at the pipeline, what we have shared till almost 2030, it gives me just an indication of 2,000 odd rooms on a current sitting base of more than 4,000 odd. So how do I see this thing? How do I reconcile our 2 year back vision 2030 and the current pipeline? Do we have to materially scale up our managed rooms efforts to so that we at least be closer to that thing? Because on 4,000 we were assuming 4,000 kind of additional. We are ballpark in the range of 2,000. So we need to bridge the gap of almost 2,000. So what's the management view on this particular part?
No, great question, Amit. And all I can say is that all of us in the organization are single-mindedly focused on growth, and whether that's through management contracts, through partnerships, etc. And in just this last quarter, as you know, Vineet ran through the 4 hotels that we've announced. We continue to focus on this. It has our complete attention, and we hope that with that focus and with that attention, we will be able to drive further opportunities for growth for both Oberoi and Trident.
So we should be certainly be optimistic about that particular thing. At least we closer to that particular vision what we had mentioned.
Yeah, I mean, what I'm saying to you is that is our vision. That is what we're going to work towards.
Right.
And you know, it's very important for us to drive growth. And if you just see the announcements that we've made in the last 12 months, we've still got part of 2026 to go in 2027. So there's still opportunity for considerable growth. At least I remain hopeful and optimistic.
Okay, nice to hear that. And second, just in the extension of this particular question, as a hotelier and the things what we have seen in last 3 years, what are the challenges, new challenges which has emerged in last 1 or 2 years, which may not allow or will act as a deterrence to this particular vision? What I'm trying to indicate from here is that we have seen like a couple of hoteliers saying that some clearances are getting delayed. And in one of the recent comment from you only in the today's call, we see that one of the hotel moved from 25 to 26. So what are the challenges, be it regulatory, be it human resource, or be it some like new greenfield land level thing? So just wanted to hear from you what are the challenges current hoteliers have started seeing in the last 1 or 2 years because of the rapid expansion from all the hotel companies across India? Yeah, that's it.
No, thanks, Amit. Amit, I don't know if there's anything that has changed substantially in the last 1 or 2 years. I think during COVID, and this is my personal view, is that I think we as hoteliers, or as the hotel industry, were not kind to our colleagues. There were large layoffs of people, and this really pains me a lot. As human beings, we should be supporting one another, at least people within our organization or within the companies that we work. And that really was something that the industry did not do during COVID. And as a result of that, you can look at admissions to hotel schools. There's enough published on this to see that positions weren't vacant, or admissions were lower, positions remain vacant. So one area of concern is, of course, people. And that's core to who we are and a core to our business. We stand by our colleagues, we support our colleagues, and that is a very, very important value for our organization. But human resource is a challenge for the industry. What hasn't changed is the approvals, the delays as a result of that. Those things haven't changed in the last 2 years. They existed even before. And that can cause delays for hotel openings. Land is also another issue, securing land. Land values are very high in city locations. You have to look at mixed-use developments. And obviously, location is key to a hotel's success. I don't know if I've answered your question. I'm just trying to think if there's anything else. But let me talk about the positives, right? Let's not focus on the negatives. I think our economy is growing strongly. The ability to spend on high-end experiences and products is strong and growing rapidly. So I think there are many, many positive things that are happening in our country, driven by strong economic growth. And these will continue into the future. So I think there's a lot to also celebrate, and just not focus on the negatives. Let's focus on see how we can capitalize on the positives, and at least not worry about negatives that are beyond our control.
Fair enough. I'll just fall back in queue. I have a couple of notes. I'll come back.
Okay,
Thank you.
great. Thanks, Amit.
Friends, request you to limit yourself to 2 questions because there are a lot of participants waiting in queue. Take the next question from Abhishek. Abhishek, please go ahead.
Yeah. Hi. I just see there's a rental income from investment property in the annual reports for financial year 2025. What is that, and from what are we getting that money for?
So that rental income is mainly coming from Oberoi Center, which is our building in Gurgaon.
Yeah. This is just to give you a little bit more detail. We have the Oberoi Center, which is in Cyber City in Gurgaon. It's roughly about 110 square feet, and it's a 7-story building. We occupy one of the floors, which is the top floor, and the others are leased out to various parties. One of our key tenants there is BMW, that's taken multiple floors.
Okay, and there's another just a follow-up question on the Pride business. Out of 2,000 odd crores, 2,700 crores of revenue which we have booked for financial year 25. How much of that is from the flight services business?
I'll leave that to you, Vineet.
So I'll give you overall, if I look at Q1, I'll give you the Q1 numbers. We had roughly 110 crores. That's our revenue. That's the figure I can share, but nothing more than that.
But for financial year 25 on a whole year basis?
25, I can share the numbers separately. I don't remember the number, and I don't have that handy with me.
Just to understand what is, why are we not very, transparent about revealing this numbers for this business? Is there a reason for it?
I don't think there's a reason for it, and we'll certainly look at it, but at this point we're not. And Vineet and I'll have a chat about seeing how we can include that going forward. But what I will say is that, the Oberoi Airport Services had very strong revenue and very strong flow through to EBITDA. And what I can also say to you is, despite that business closing with the lounge contract coming to an end, we've been able to offset that at an EBITDA level as well, with the flight kitchen business. So there's strong demand. Our focus is on international flights where margins are better, and the business is doing very well. But what we will look at is seeing whether we can give you or share with the market details on that business.
Yeah, sure. And another thing, if we want to connect with you offline, just no, I'm not. It's not a question. Just if we want to connect with you offline, how should we do that? Writing it to the investor department, or how should we do that?
Yeah, I mean, maybe you can. We'll be in touch with Naveen, and we can look with Naveen's help. We can do that.
Sheikh, my email ID and number there on the invite. Maybe you can just drop me a mail and I'll take it forward.
Sure. Thanks,
Naveen.
Abhishek.
Thanks for that too.
Thanks, Vikram.
Thank you so
Before
much.
we take the next question from Sangeeta, may I just read out a couple of questions on the board?
Sure.
Okay, Amit, who's been trying to get come on to the to ask his question. He says, just wanted to tell Mr. Vikram that last week I was in Lombok and it's an amazing property. But my suggestion is that you need helicopter services as it is a remote island.
Yeah. No, it's the hotel is a fantastic hotel. And Amit, I'm so glad you stayed with us. I hope we looked after you well and you were happy with the service and the lovely people we have who work at that hotel. Touch wood, our guest feedback is very positive. I think with a helicopter service, if you have to underwrite that, it's a substantial commitment and a substantial risk. And therefore it's something we haven't done. There are regular flights from Bali and also from Kuala Lumpur, and I believe Singapore, perhaps now as well, to Lombok. So access is a little bit easier than it was previously. And there's also a very convenient, in fact, what I normally do if I'm in Bali is there's a ferry crossing. It's like a large boat, which is very comfortable and takes you from Bali to Lombok in about 2.5 hours. And it's quite a nice experience as well. So there are many ways to get to Lombok. We'd be hesitant to look at a helicopter service because I think there's a risk associated with that, and you need to underwrite it, which we wouldn't want to do. But the hotel right now the hotel is doing very strong occupancy. This is peak time for Bali and for Lombok, and Touchwood, both hotels are doing very well.
Thanks, Vikram. Okay, his questions. My two questions are regarding the London property that we are coming up with boutique properties. Do we own the land? And are there any restaurants and shops coming there along with the rooms?
Yeah, no, so absolutely with the Mayfair Hotel, it's a 125-year lease from Grosvenor Estate. So we don't own it, but it's on a very long-term lease of 125 years. And there will be a restaurant and absolutely a bar and nice common spaces for our guests as well at Mayfair, London.
And the second question is that we're doing a lot of managed deals. Are they for a particular period or the contracts are for an infinite period?
Contracts for hotels are never for an infinite period. They are for a specific number of years, and these are varied, from 20 years upwards. And there's also typically in hotel contracts renewal clauses for another 10 or 20 years. So these are very long-term contracts.
Thanks, Vikram.
And I'm talking about the industry in general, and we are no exception to that.
Okay, question from Anshu Chaurasia. As a hotelier, what is the targeted IRR for acquiring a new property, and whether it's a greenfield or a brownfield project?
Can we, I don't know if we can, do we disclose? I mean, I have no issue with looking at internal benchmarks, but I don't know beneath if I should do that.
His question is on ARR, right?
No, IRR.
IRR.
Yeah. So,
no, of course, I would say we have a benchmark, considering that we have taken into consideration the return on equity to the shareholders, as well as look at the debt levels, what the company can afford. But yeah, it's a decent double-digit IRR which we look for, but I'll not be able to give you the specifics.
Yeah, but may I just say one thing which may give you some comfort is that we have internal benchmarks that we strictly follow on IRR and in terms of enterprise value as well. And it's something that when we do our projections, whether it's for an owned or managed hotel, even for managed hotels, we always run the numbers of how we feel we can perform. And we do that with honesty and integrity with our partners. So we really present what we believe is a true and fair picture. And we tend to be conservative. I'll give you an example of I won't mention the hotel, but when we did a study and shared the numbers for occupancy, ARR, etc., and P&L. Let me not even, because it was really on revenue side. On the cost sides, we're reasonably efficient. It was substantially lower than what was subsequently shared by a consultant. So we are conservative with our projections. We make a commitment to our partners, and we want to not only meet those projections but exceed those. And that will hold us in good stead in terms of building a strong foundation of trust and a strong relationship with our partners. We don't want to ever be in a position where we let people down.
Thanks, Vikram. We'll take the next question from Rupam Jaiswal. What's your view on upper luxury segment, and how do they trend in terms of ARR and occupancy? And does international travel lead it? Is this bound to see exceptional growth in future, and where are we placed?
Yeah. So we've seen, if you look at, let's take a 15-year horizon, we've seen a dramatic change in the contribution of our Indian guests to overall revenue. And I'm now specifically talking about leisure, since the question was at leisure, but this applies to all our hotels. And we remain very optimistic that that trend is going to not only continue, but increase at a more, even a greater pace, a more rapid pace of growth, just given what's happening in our country. So that's the first point. The second point is that international travel and international guests staying at our hotels, they're not our Indian guest is the single largest segment, followed by the US and the UK. And it's a very, very important segment for us. I know you'll be familiar with figures released by the government on growth of international travel to India. And I think we'll all benefit. The industry will benefit if we achieve those targets. And our country, of course, will benefit if we achieve those targets. So I think we should really see how we can work in partnership with the government, both at a central and state level, to drive foreign visitors to our country. It brings in foreign exchange. It also creates ambassadors to our country. And I'm sure that translates into business opportunity as well.
Thanks, Vikram. We'll take the last question on the Q&A book before we get back to the question and answer form. What is the occupancy for full year FY25 at consolidated level?
I think it was, I feel like saying 78%, but just give us one moment.
This was from Vineet Bajaj. Vineet, just hang on for a
Yeah, just
second
give
till.
for EIH, it'll be.
Yes.
For EIH hotels, this is mainly on overall EIH hotels, what we have in India. We were running occupancy for the full year at 80.7% last year.
Thanks, Vineet. Okay, friends, we are in the last 10 minutes of the webinar, so request you to limit yourself to just one question and make it short. Thank you. We'll take the question from Sangeeta. Sangeeta, please go. Please unmute yourself and go ahead. Sangeeta, you need to unmute yourself. Guess there's some issue out there. We'll take the next question from Rajiv Bharti. Rajiv, please unmute yourself and go ahead.
Yeah, hi. Good morning, sir.
Hi,
So
Rajiv.
I have three questions actually. So one thing is actually CapEx part of it. Now, when I see the schedule versus let's say Q2 FY23 of various projects you have given, then out of the let's say 21 and now they're scaled to 25, 14 are delayed by close to a year and 4 are delayed by close to 3 years. So this is in terms of timelines which we are giving. How confident are we that these would be met? And in that way, very happy to see that the gear is back in the fold again.
Thank you. Like I mentioned, our endeavor with our hotels where it's owned by EIH or has substantial equity, we meet the timelines that we set. That's important for us. Sometimes that's not always the case, and I don't know if I can get into specifics to just give examples. Maybe I shouldn't, because I can think of one EIH associate hotel where there's been a delay as a result of some land-related issues, but we've now solved those, and when we're pressing on with that. With managed hotels, like I mentioned earlier, we have far less control, and Thuraiya, for example, is one of those where there's been a delay. We're opening the first hotel in Thuraiya next year, but there was also a second hotel which has been delayed, and that is really beyond our control. It's a Thuraiya Gate project, and there have been delays or deferment of certain, or certainly of our hotel, and so that's really what I have to say. In summary, for our owned hotels, our endeavor is to meet the timelines we set, and sometimes there are things beyond our control. As an example, one specific land-related issue with our partners, if there are delays, we see how best to work with them to meet the earliest possible timelines for opening of the hotel.
Sure, sir. So regarding EIH International, when we are seeing this last 4-quarter performance, you have seen 20% RevPAR growth. But when I compare the annual numbers, they have moved up, I think, by 3-4%. So what is the seasonality in H1, H2 in this business?
In fact, in places like Indonesia, Q2 of our financial year and Q3 are strong because they have their rainy season that starts in November, if I'm not mistaken. So it's in fact in many ways opposite to ours. Egypt, on the other hand, is again occupancies pick up in the winter months, similar to India because it's very hot. Marrakesh is also similar. Because summers tend to be hot there, so winters are typically periods of higher occupancy. And Mauritius seasons are reversed. So again, summer months are better in Mauritius. Their summer months are better, which is our winter, because it's reverse season. So it really is a mixed bag, to answer your question.
So lastly, this tried Oberoi Hyderabad, is it a conversion or this is a greenfield asset?
It's a greenfield.
Great. That's all from my side. Thanks.
Thank you very much. Thank you. Thanks, Rajiv.
Naveen, you're on mute.
Vineet, how much time do we have? Because there are some questions on the Q&A board, some participants lined up.
We can. I have a meeting at 12, Naveen, but I can. I mean, if I'm 5, as long as I'm not too late, so maybe a few more minutes, or we can also ask people to send their questions through. I leave it to you.
They are all follow-up questions from Vaibhav, Raghav, and Amit. Guys, request you to send me your questions and I'll forward them to the management because Vikram's already running late for his commitments. Just give me a second.
I'm really sorry, Naveen. Maybe next time I'll set an hour and a half aside. I'm sorry.
So friends, may I hand over the floor to Vikram and Vineet for their closing remarks before we wind up, please. And
No,
just one sec,
yes,
I'm
exactly,
sharing
please.
my email ID, so any follow-up or unanswered questions, request you to write them to me and I'll take them up. Yeah, Vikram, please go ahead.
Vineet, sorry, Naveen, I don't have much to add to whatever I've already said in the questions that I've answered. If I were to, give an overall perspective, I still am optimistic about the India story. I think EIH will benefit from that, and we continue to work in the premium segment, which we believe is a segment that has tremendous opportunity in our country. We continue to drive ARR to the best of our ability. Sorry, you can maybe cover that. Vineet was giving me a note, but I'll ask him to add his comment as well, rather than reading out what he's telling me. So yeah, we remain optimistic, and there are in any business you have ups and downs, and what happened in the month of May that extended into June had an impact on all of us. So those risks always do exist.
And I would like to add that we continue to drive our vision for 2050, and we are working towards that goal. I would say we are pretty much focused to deliver what was committed 2 years back.
On behalf of SKP Securities, thank you very much, Mr. Oberoi and Mr. Kapoor, for taking time out to patiently answer all the queries. And we look forward to hosting you again in the next quarter. Thank you very much. Thank you, ladies and gentlemen.
Thanks, Naveen. Thank you very much, everyone.
Thank you.
Bye-bye.
Thank you.
Bye.
And have a
Thank you so
wonderful
much.
day.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming con calls.